Good afternoon. We're moving on to the next panel, which is focused on auto. And we have three great speakers who represent different aspects of the business. And we're going to be focusing on what you should be investing or what the auto lenders are looking at investing in over the next period of time. The three panelists on my far right is Michael. He's at the TD Bank. I think many of you know who TD Bank is, so I don't have to give much of a discussion. Scott is in the middle with Nissan. Again, you all know Nissan. And Scott runs the captive finance group. So we've got a bank lender, a captive lender, and then Rick works with a mixed company that does subprime and prime lending together with other aspects, which he'll get into. So you have really three different speakers, all of whom have a different focus on the industry. And I think that gives a unique insight that we wouldn't otherwise see. So I'm going to get right into it because we have 30 minutes and each of them could speak on topics for 30 minutes. So, gentlemen, let's start with the first question. What is the one area that keeps you awake most at night, and how do you see, if at all, technology assisting you in that? And I'll start with Michael on the right and then work our way around.
I'd say number one issue, quite frankly, right now is all around fraud. For me, fraud is a problem. Increasing the numbers are crazy, and I don't think they even represent the true degree of what we're seeing. I saw some Equifax folks here. They recently put out a publication said fraud is up 54%, auto fraud is up 54%. Identity fraud up 40%, and something that is relatively new, you're seeing the instance of revinning increase about 30% year over year. So these are all huge concerns and factors. And quite frankly, I think that technology, AI, is enabling some of this fraud versus the other side helping us detect it. We're looking for solutions. We're looking for signals throughout the marketplace that can help us with that. And just unfortunately, this is a group of individuals and organized crime that moves much faster than I can.
Scott?
Yeah, I have to agree. Fraud is the devil, and we're all trying to move as quickly as possible. So automate, make the decisions, get the answers, and the criminals are moving much quicker than we are. And I look at our business, and our delinquency is still, we're in very good shape. And the frequency of loss, very good shape. But the actual losses are enormous because we've got so many full balance charge-offs because of fraud. And really knowing who the people are, that's the thing. We're behind. And as soon as we close a door, then another one opens. So that's really, we're playing catch-up.
Rick?
Yeah, I mean, it's hard to add to a lot to that, but I'd say, the big danger is you model for credit risk. It's really hard to put a model together for your profitability and for your risk when a large percent of your losses are coming from fraud. It's really hard to determine that. And I think the scary part is it has the potential to get worse as we start to digitize the whole car buying experience. It's just going to introduce another layer of new risks. My view is it's almost time to take a step back and restart. I don't think we know how big the problem is. For every deal that we think we've confirmed as a fraud, there is a number of deals and they're not. So I think, without knowing the size of the problem, I think it's hard to tackle it. And then I think, to the point, there's so many different types of fraud. I think we need to, and how you solve for true name fraud, identity fraud, 5 different types of frauds. I think we need to identify them, work with we have to partnership with the dealerships here. They're kind of our last line of defense quite often. So how do you work with your dealership? How do you work with technology that for the first time to your point, Scott, we're not reactionary. We're not solving yesterday's problem today. We're actually looking kind of forward. I was actually driving in today, just an idiotic thought perhaps, but I was thinking, companies around the world go out and hire hackers to try to hack into our system, make us kind of hack-proof. is there a view out there? We've got to start trying to think about how the mind of fraudsters and try to figure out how we do that. Otherwise, it's just going to continue to grow.
I'd say we've enabled fraudsters to be more efficient, right? And they're good, but we've also been on a mission as an industry to take friction out of the process, right? We're making it easier to get approved. We're making it easier to verify existence and whatnot. And all that friction was in past our prevention. And I think, we're certainly in this world where everybody's talking about going faster and enabling decisions with AI, going slower might be the answer. Taking an extra day to make sure that person really is, because if I actually stop operating efficiently, I pass my fraud over to Scott because they want the car today.
No, and that's very true. And we stop one, and then we see there's 6 or 7 others where they were successful. So I might be okay, but then that means someone else. But it's just it's a never ending. We're playing catch up.
Let me go a little off script. If there were a registry that talked about each of the type of frauds that were occurring that was live and searchable, would that assist you to know what the newest game in town is, so you could try to control or not?
I think without a doubt, again, we're reactionary today. And there needs to be something done that we are, at least at par, if not ahead of tomorrow's fraud. And whether it's registry, whether it's sharing of information, whether it's better technology, whether it is maybe slowing down a bit, I don't think there's a one solution to this problem, because the problem is too multifaceted.
Well, I think a lot of the information exists in the ecosystem, right? And you think about how much work goes into creating a false identity, matching a mature credit profile with a young borrower, and when they actually want to perpetrate the fraud, the auto stacking, you see 8-10 applications for credit across 8-10 dealerships with taking delivery within 24-48 hours of 8 vehicles. We know that is happening in our ecosystem. We just aren't very well coordinated in order to work with it.
So let me just go through this a little. Fraud is interesting to me because I don't know how much you're aware of what's going on in the finance industry right now with the fraud, but there's been some, not so much in the car industry where we're understanding there's significant fraud. In the truck industry, there is a ridiculous amount of fraud going on right now. So if you found a fintech solution that solved your problems, would you buy it?
Uh-oh. Yes.
No, I would too. I guess at the very first CFO I ever worked with at Daimler, I went to him. To me, I always thought finance was absolutes. It was debits, it was credits, it was black, it was white. And I went to him expecting a very clear answer, and he said, Scott, it depends. So the answer is always it depends. How much does it cost? But absolutely, we want to prevent loss. That would be something that would be of high value.
Yeah, there's various estimates, but I read something recently that for every dollar of fraud loss, a finance company, a bank spends $4 to collect that $1 through legal costs, time of people, all the various pieces. So it's a pretty easy business decision.
Which you said downstairs when we were having coffee. If we made cars that people couldn't steal, it wouldn't be a problem.
My fraud would be
or if they were less desirable, then people wouldn't want to steal.
Scott's fault.
Yeah.
Let's move on to the next topic. We've talked about fraud, which is sort of the negative side of it, but the other aspect of it, who gets approved? And can technology assist in that area? And Rick, I'm going to let you start on this one.
Yeah, I mean, we definitely think there's opportunities right across the ecosystem for technology, for AI, for machine learning, from the application decision process, STIP management, funding, right through to, can it be used in the portfolio servicing, recovering, remarketing. we've been using on the non-prime side an AI, two different AI companies for 18 to 24 months. And I'll say that it's that portfolio using machine learning AI is performing better than the portfolio that was not using AI. It comes with a cost that's outside the usage cost. It comes with a cost today that I find is lost volume. So I think it's really adept at identifying credit quality that doesn't fit your buying appetite or your credit appetite. But it hasn't, I think, delivered the other half that everyone talks about, and that is, how do you find the business through AI that other people are looking at saying, no, you shouldn't buy it, but you should find it. They can actually come up with a way to find it. So, and I think that's got to be, there used to be that, the old saying, the best indication of future performance is past performance. I don't know if that's true anymore. I think we are in a world where just constantly changing, the consumer's changing, the business is changing. And if we're using models that are based on data from 1, 2, 3, 4 years ago, I don't think that's adding value any longer. I think somehow we've got to move to an AI or technology that has the ability to use data from a week ago, from a month ago, using data from banking statements that will pick up changes in a consumer's activity. And I think until we get there, we're happy with where we are today, but I think to truly take it to the next level, I think it has to continue to mature. I think, not speaking, for the two gentlemen on the right, but I think on the prime side, there's been a bit more cautious moving into it, whether it's legacy technology systems or privacy data. But I don't think there's any doubt everyone will be moving towards, that AI world.
Not only the AI, but are you finding your clients also want instantaneous results for their credit application?
Yes. Yeah, no, they want to know before they submit it, and it needs to be easy to submit, and it has to have as little information as possible. So that's kind of the world we're in, and we're constantly trying to improve. I've got our head of risk here. We're trying to shave time while also delivering quality decisions so that car can get sold. The unique position I have is I work for a car company. So it's really, and we rally our team around the phrase, we make new car day possible. So that's kind of our shining star. We want to make new car day possible. So we have to do that quickly. We have to we have to make the right decision. Otherwise, it impairs our ability to continue to make new car day possible.
So this is where it's interesting, where we have the three of them. So we have the bank where you're not focused on selling cars, you're focused on making money, as is the car company, but in a different way. You're money on money. If you sell the car, you make money, and you're hoping that they go bankrupt so you can get recoveries done.
That wasn't in my...
I know it wasn't. So, Michael, when you're looking at using AI and the credit decision, do you think it's the same as in the non-prime, or do you think you're using a different type of technology?
Well, I think there's similarities. I think there are going to be differences in the non-prime because just the level of the quality of the information that we've relied on heavily is not as predictive. So you have to be a little bit more inventive. I've heard models where certain lenders are bringing in data from the social profile of the applicant to link to who they hang out with as an indicator of probability of default. That I don't think we would try to do in the prime space, but we would certainly look to augment some more things in the prime space, like income verification or that sort of stuff. But yeah, there's a lot of things that I think you would want to do from alternative sources of data that would be applicable to across the full spectrum. But I think you have to be a little bit more inventive in the non-prime space.
Rick, you used to work at a bank, and now you're in a non-bank. Do you find that the processes have changed because of that, and the decision changes?
Oh, without a doubt. I was part of an American bank. So I think I will say that, being part of a smaller, non-regulated entity, decisions can be made quicker. but I think there's more limitation to the spend that's available. You're a bit more limited to there, and I think I think we're able to react a bit quicker to situations than sometimes the larger, more regulated industries are. But as I say, it's sometimes it's a different set of problems. But there's problems on both. But I just want to say, just in addition to this whole idea that we're on the credit adjudication process, which again we've been using for 18, 24 months. We've also introduced machine learning, both prime and non-prime, into the funding automation process, because we think we can take out a lot of value add job, non-value add work can be taken out, and you can kind of use on machine learning AI to get things done quicker, safer. And we're looking at is the possibilities for income verification. Can we use machine learning on that? Can we use machine learning on how to find cars? Can you use machine learning to figure out how to reduce fraud? So I think we've just started to scratch, what's available in the auto financing world or the auto sales world with AI today.
And actually, that's a beautiful segue into something I want Scott to talk about. He's developed or has a slogan of the non-call center call center.
Non-call call center. Yeah, that's kind of our orientation. Yeah. We don't really want people to call us. Not that we don't want to talk to people. They don't necessarily want to call us, but we're only open a finite amount of time. So as far as from an orientation, how we're going to work on the business and change our business, we want to move to as many self-serve options as possible. So whether it's a customer or dealer, they get everything they need so they can do the next transaction. And that way we can have our people work on the more challenging things. So AI can certainly complement everything we're trying to do in that as we move more to customer portal and the app and align with the sales company. And then our people can work on the more challenging problems, which we can then, that's more fulfilling for them. We can learn what that and automate that and then give them the other more challenging, so that the people are always important. But if you call us, you're going to have to wait, and we're not going to be able probably to answer your question immediately because there's so many other people there. So we want you to go online and get everything. It's more of a transactional approach is what we're thinking in the call center, the no-call call center.
Does anyone want to add to that sort of concept, or do you want to move on to the next?
I think just in terms of AI, whether it's non-call call center, I like that. But
that means CD stealing it, right?
Yeah, a whole new brand has been launched. Just the other uses, we're talking about losses and fraud and whatnot, AI in terms of developing collection strategies and linking the data. We have a tremendous amount of data in this business, from the origination right through the disposition, and being able to run models that can bring that all together and inform our agents of the next best action and when to take action, and where you might be able to have more patience with a consumer than another one, and linking in that if you lend this customer a Honda Civic, you're going to have a higher loss than if you lend them a Nissan Rogue. All this stuff is available, and how do we harness it? I think AI is going to be the hero of the next couple of years across everything from adjudication to collections to non-call call centers. It's endless.
Rick?
No. Okay. I think that pretty well summarizes it.
Okay. So let's move on to the next topic, which may be near and dear to many of your hearts, is how do you buy your, you've got a system in place now. You all acknowledge that your systems are good, but not perfect, and that you can't get rid of your existing systems and start greenfield for a whole bunch of reasons. So when you're looking at, we've already established today, if you could find a great fraud detection policy, that would be great. If you found a better AI credit adjudication, that would be great. When you're going through the process, how do you decide, and where does it fit in to your current technology, and what's the buying method for that? I'll start with you, Rick.
Sure. I'm sure everyone has a different process. I think we start with kind of evaluating who we're dealing with. What's their experience really in the market and in the specific issue we're trying to deal with, can we look at them to say they've proven track record of being able to help us here, or is it truly a kind of a startup to where we're going to both learn from each other over a period of time, and there's going to be a value add, but it's not going to be today. And if we have an issue that we're trying to solve today, I think we're looking for somebody that brings that expertise. You have to look at on today the complexity, the costs, the time for the implementation of these different programs, because they can range so much. And then I think we look at it to say, is the technology that we're looking at, is it really core to our business? There are companies out there that do things full time, all day long, and they're really good at it, and that's the only thing they do. And they keep their, what they do, they keep their standards up to, their technology up to the standards. I don't know whether we want to try to better that. I think that's where you kind of use that kind of API and you take on what they're offering. I think there's other cases where, it's a niche market, or there's opportunities to really where we believe it's better for us to own the technology, the data, the roadmap. There's instances where there's just not an in-box solution to what we're trying to do. I think those are the ones where I think Greenfield is where, we're going to start trying to make those investments ourselves. So I think it's really do we believe somebody out there is doing it the best that can be done? Why bother trying to beat that compared to we think we can potentially build something with a partner that's more specific to us?
Scott?
Yeah, for us, all the technology goes in the cars. So for the core of our business is not technology. So I'm interested to buy it. I'm not going to build it because that's not our core. So we want to buy it. And if we're going to buy it, we have to have APIs. We have to be able to do the integrations. That's key. So we're always looking. We've kind of got a hodgepodge of things as opposed to a beautiful tapestry. It's more like a quilt, this patched together with this. And we find a way to make it work. But we've got to have those seamless integrations. So that's what we're really interested in.
So if someone at this conference came to you and said, we have this great product and we want to implement it for Nissan, what would be the process? Like, they come to you first, or
yeah, they would have to come to us first. They'd have to kind of demonstrate a need, but also be warned, like lawyers. Every vendor that comes they're the smartest vendor you've ever talked to. So we proceed with caution, and we want to understand and understand how it can help us with our business. But we would definitely be looking at that and finding a way to be able to integrate it in our existing core systems.
So you have like a 40-page engagement letter for them? Sorry.
No, just one page.
Oh. So not just like lawyers.
40 sounds short.
And what about for the bank perspective, Mike?
Well, I have a whole different issue. It's, if anybody's worked with a large Canadian bank or tried to sell to a large Canadian bank, you understand that legacy systems are very difficult to work around. They're very expensive. We spend a little more time trying to figure out if anything we integrate will break something else versus whether it will work for us. So we're very, very selective, but on the thing, we are in the kind of we can't build it model, but how do we integrate it? So we want to be very, very cautious that we buy cautiously because we don't have the ability to kind of buy often.
I didn't mean to imply that we're quick. We're also very cautious.
A Japanese company isn't quick?
No, there's processes we have to follow. Yeah,
I'm shocked.
Hierarchies.
Shocked. So let's get on to the last topic because we have 5 minutes. And I think this is the one that I found most interesting, which is the tensions that you see within the auto buy and the auto finance. And Scott, I'm going to start with you on this because I think as a captive, you're more tied to a network than the other two companies. So Scott?
Yeah, tension is, that's a broad term. Now, there's tension. It's built naturally into the process. I said to John a few times, my grandfather's been dead since 1983. If he was to get in a car right now, he would believe it could fly. The technology is otherworldly. It's incredible. He wouldn't know how to start it. He could probably open the door, maybe. He could definitely close the door. And yet, if he went to the dealership, he would 100% know how to buy a car. There's so much tension there, and we're lucky. Automotive is kind of an arrogant space. We've not had to change how you buy a car because people want cars, they need cars. So there's tension between the dealer and the customer. There's tension between me and the dealer. There's tension between the car company and the dealer. So really, those are the points where we have to come together. There's only one customer, and yet the dealer thinks that's their customer. It is. They're the only one who's got a real big investment here. I don't. Then I think it's my customer because I provided the funding to be able to get them down the road. And the car company has spent billions developing the car, building a brand, and generating the lead. So that's trying to pull all of that together and solve that tension so that we can service the customers at the center of what we're trying to do. And automotive is being dragged into this space.
Mike, do you see that when you're interacting with the dealers as well? That there's, I won't call it it's not a negative tension, but there's a conflict of interest in a sense.
Yeah, we don't experience the OEM tension with the dealer, but certainly there's friction all through the process, and there's this industry is there's thousands of companies trying to disrupt how an automobile is sold. Nobody's been able to do it end to end. You still have to go to the dealership to sit in that office for 4 hours before you get the keys, and everything up until that point, there's friction and tension, multiple players, multiple options. So you're trying to figure out how to navigate that by doing your part to the quickest and most efficient way possible. But it's an interesting model as you see some of these new OEMs come to market that are opting direct to consumer and talk about who owns the customer there. It's a whole different conversation, but there's a lot of interesting things happening in the industry. But I don't think that tension is one of the factors that's going to be eliminated soon.
No, and it's a good thing. I mean, I think that ensures that it's the best it can be, but there's room for improvement for sure.
Yeah, I mean, I think Mike and I would be probably closer than Scott's. Where, I mean, there's a dealer as much as there's a partnership obviously between a dealership and a car financing company, but the dealership wants to sell as many cars for as much as money and make as much profit. As the financing of those vehicles, we want to be buying, the paper that is profitable, that's going to pay us back. It isn't, fraught with fraud, has good controls in place. So, there's going to be tension because there's kind of two different people, and they have different views of what success might be defined as. So whether it's you're not approving enough business, or you're asking for too many conditions, or you're not closing, you're not getting the money quick enough, there's just tensions, throughout. And ultimately, I think the dealerships that we have the truest, best partnership with, that truly understand, for it to be a successful partnership, it has to work for both sides. They're the ones that I think at the end of the day, there's less friction, because I think there's an understanding of, we understand what drives them, they understand what drives us, and you kind of meet in the middle. But I don't think you're ever going to get rid of that tension. That is that's been there for 100 years. It's going to be there forever.
We've come to the end. I want to summarize it in my head. What I've heard is there are a lot of areas that can be improved on the technology side, and the finance companies are both open to it and are, in fact, encouraged to see what is going to happen in the next while, and they are open to listening to the various fintechs and what they can provide to them. Yep. That be a fair summary?
Yeah.
Absolutely.
Yep. Yeah. I'd just add to that. I think there's some issues that need to be addressed for anybody that's trying to solve problems from an industry standpoint. That's we go back to fraud. Fraud is not a competitive advantage for any of us.
Yeah.
So if we have one industry solution to buy that will solve that for everybody, it's a much easier sell.
Thank you. We have come to the end of our time. The three speakers, I'm sure, will be here for at least a while if you have any follow-up questions. Thanks, everyone.